Hello everyone. So now we are on to the 18th lecture of amalgamation, and in this lecture we are going to study the topic of external reconstruction. Now, very first lecture, if you all remember, we already discussed what is external reconstruction. If you all remember my words, I told you it's an old wine in the new bottle. Old wine, old company. In the new bottle, new name. The company remains same, assets remain same, liabilities remain same, shareholders remain same, everything remains same, only the name of the company is being changed. And I also discussed in the first lecture several reasons may be possible for that. Maybe with that name the company has lost the reputation, so it's changing the name. Otherwise the dynamics of business are really good. However, from accounting point of view, it is a kind of amalgamation because one company goes into liquidation and you have to register a new company with a new name with the Companies Act, with the Registrar of Companies Act. So it is a type of amalgamation only where one existing company goes into liquidation and is taken over by another new company, not an existing company. But practically what happens is the board of directors are only changing the name of the company. Now, from accounting point of view, the accounting entries in the books of transferor companies remain same. I repeat, the accounting entries in the books of transferor company remains same. Those 14, 15 entries what we have to pass remain same. And in the books of transferee company, we don't have to identify is it merger or purchase. It is always purchase. If it is an external reconstruction, we never have to follow pooling of interest method. We always have to follow purchase method of accounting. Look at this paragraph, all of you, be attentive in your pamphlet. You'll find it, external reconstruction. I'll read it once. Reconstruction means reorganization of a company's financial structure. Reconstruction cannot be considered as merger or amalgamation. Yes, theoretically it's different, but from accounting point of view it is same. It may be done by liquidating the existing company and forming a new company with a view to take over the existing company. This process is known as external reconstruction. In this case, the undertaking being carried on by the company is transferred to a newly started company consisting substantially of the same shareholders. Means all the shareholders remain same only. As I said, shareholders, assets, liabilities, everything remain same. With a view to the business of transferor company being continued by transferee company. An attempt is made that a newly started company has a sound financial position and good set of assets and liabilities recorded in the books of transferee company at their fair values. For example, if an existing company A Limited goes into liquidation and a new company AA Limited is formed to take over the business of A Limited. This is a case of external reconstruction. Existing company goes into liquidation, new company is being formed. From the viewpoint of an accountant, external reconstruction is similar to amalgamation in the nature of purchase. I repeat, this all of you have to remember that external reconstruction is similar to amalgamation in the nature of purchase, not merger. The books of transferor company are closed, so those entries remain same. And in the books of transferee company, the purchase of business is recorded. So if you want, you all can note down this as a note somewhere in your notebook that transferor company, the entries will remain exactly same. Transferor companies, the entries will remain exactly same as we have done up till now. Transferor company, it will remain same. Transferee company, we have to follow always purchase method of accounting. In short, in these kind of questions, we don't have to distinguish is it amalgamation in the nature of merger or purchase. Secondly, how will you identify in the question that it is external reconstruction? The word reconstruction scheme will be given. Okay, the word reconstruction will be mentioned. So let's take up with question number 1. All of you look at question number 1 of external reconstruction in your study material. Yes, so look at question 1 of your study material of external reconstruction. It's in the same pamphlet of amalgamation at the end. Following are the assets and liabilities of W Limited as on 31st March 2019. Equity share capital rupees 10 each, fully paid up 4,50,000. So 4,50,000 divided by 10, 45,000 equity shares are there. 6% preference shares also of rupees 10 each, 2,50,000. So 2,50,000 divided by 10, 25,000 preference shares are also there. 9% debentures of 100 each, 3 lakh. Unsecured loan, creditors, and then land and building, plant and machinery, stock, debtors, cash and bank. Okay, this P&L account given on the asset side means it is accumulated loss, and that may be a main reason. Either you'll be given on asset side or same P&L account will be given in reserves and surplus as a negative figure. Okay, either you'll be given this on the asset side or you will be given in reserves and surplus as a negative figure. We, as per the new Companies Act 2013, write it in reserves and surplus as a negative figure. Now, this is mainly a reason why the company may be going into external reconstruction, because presently the financial position is very big because of a loss of 3,35,000. So generally in such a case the companies go for external reconstruction. Now this word, the following scheme of reconstruction was framed. This indicates it's a question of external reconstruction. As I said to you, how will you identify in the question in exams? It is a question of external reconstruction. The word reconstruction would be given. As it is given, the following scheme of reconstruction was framed. This word indicates it's a question of external reconstruction. A new company S Limited to be formed to take over the business of W Limited with an authorized capital of 3 lakh equity shares of 10 each and 12% 1 lakh preference shares of 10 each. Authorized capital just to be mentioned in the balance sheet, no relevance in journal entries. Okay, there's no relevance in journal entries. We have seen that earlier also. Next, S Limited to issue 3 12% preference shares of 10 each but rupees 2.5 paid up in exchange of 1 preference share of W Limited. We'll see that later on when we make the workings. Similarly, S Limited to issue necessary number of equity shares of rupees 10 each, 5 paid up to the equity shareholders of W Limited. Here also 5 paid up. Make a correction here, make it land and building. The land and building to be revalued at 40% more. This land and building given is 3,75,000. It is valued 40% more. Now the land and building revalued at 40% more. So 3,75,000 plus 40%, what is its value? 5,25,000. Value of plant to be reduced by 10%. So you all can see here plant is 3,50,000 minus 10%. If you reduce it, it will come to 3,15,000. Okay, 3,50,000 minus 10% will come to 3,15,000. And same way debtors to be reduced by 5%. So you all can see debtors here are 1,75,000. If you reduce them by 5%, it will come to 166,250. These are the agreed values. The value of stock to be reduced to not by 2. Rupees 1,65,000 directly stocks agreed value is given. Cash in bank is always at book value. Liability in respect of 9% debentures to be taken over and discharged, and then the word discharged, directly by S Limited by issue of sufficient number of equity shares of rupees 5 paid up. Means again 10 each, but paid up value 5. Okay. In the new company, 10 is the face value of shares, but 5 paid up only. Remaining 5 we will collect from debenture holders in future. One more thing to be noted. Debentures are settled by issuing equity shares and not debentures. Okay, debenture holders are settled but by issuing equity shares and not debentures. The creditors of W Limited to get from S Limited 50% of their dues in cash, hold on, in cash, and 25% in the form of equity shares of 10 each fully paid up in full settlement. In full settlement. So that we'll see how much is the agreed value of creditors by making a working. To facilitate the implementation of reconstruction scheme, S Limited issued for cash 20,000 equity shares of rupees 10 each which were fully subscribed. This is the public issue of shares. So that public issue entry will come in the books of transferee company. Ignore preference dividend and dividend distribution tax. As such, we have not taken that point in any of the questions so far. Now pass journal entries to close the books of W Limited, that is transferor company. Here W is transferor company and new company S Limited is transferee company. So transferor company also prepare realization account, equity shareholders account and preference shareholders account. In addition, we will also be making new company S Limited account as well as equity shares of S Limited account and preference shares of S Limited account. Okay, because preference shares are issued, equity shares are issued, both are issued. So equity shares of S Limited also, preference shares of S Limited also. Also pass the journal entries in the books of S Limited transferee company and prepare the balance sheet. Very long question. Everything is asked. Transferor company also, all the things, journal entries as well as ledger accounts. Transferee company also, everything, journal entries as well as ledger accounts. So first, all of you make the format of journal entries in the books of W Limited. Okay, approximately 1.5 page. Realization account, equity shareholders account, preference shareholders account, S Limited account, equity shares of S Limited account, and also make preference shares of S Limited account format. All of you make these formats, pause the video and make these formats. I repeat, which all formats you are supposed to make. Realization account, approximately 3/4 page. Equity shareholders account, around 10 lines. Preference shareholders account, 5 lines. S Limited account, 5 lines. Equity shares of S Limited, 5 lines. Preference shares of S Limited, 5 lines. Pause the video, make the formats, then we will make the workings together. Okay. Now, before we start with the things, which 3 things do we have to discuss in the beginning? Come on, tell me everyone. First, is it amalgamation in the nature of merger or purchase, right? No. I told you, here we don't need to distinguish is it merger or purchase. We always have to do it by which method? Purchase method. So only we have to discuss the method of purchase consideration. That's it. We always have to follow purchase method of accounting. Only one thing to be discussed here, method of purchase consideration. Now, since in adjustment 3, necessary number of equity shares are given, the details of number of equity shares are missing. Details of number of equity shares are missing. We will be following net asset method of purchase consideration. I repeat, because in adjustment 3, the details of number of equity shares are missing, we will be following net asset method of purchase consideration. So because the details of number of equity shares are missing, we will be following net asset method of purchase consideration. Now, as in the order we always make the workings, let's go ahead with that. First, we will make the workings of debentures and creditors. Two workings will come here because even creditors are complicated how the settlement is done. First, regarding debentures, what is given to you? See that. All of you look at adjustment number 5. Liability in respect of 9% debentures are to be taken over and discharged by S Limited by issue of sufficient number of equity shares of rupees 10 each but 5 paid up. Now, they are to be discharged at book value only. You all can see 3 lakhs is the liability of debentures. Okay. The liability of 9% debentures is 3 lakhs. And we are going to give them equity shares at 5 paid up value. So we just need to find the number of equity shares for that. Otherwise, the agreed value is 3 lakhs itself. Okay, repeat. The agreed value is 3 lakhs itself. Okay, discharged at par, premium, discount, nothing is given. Means 9% debentures of W Limited's value 3 lakhs. Agreed value is 3 lakhs itself. Book value itself. But what we need to find over here is number of equity shares to be issued to debenture holders. Since it is given they'll be issued of 10 each but 5 paid up. So 3 lakhs will be divided by 5 and we will get 60,000 equity shares will be issued. This will help us in balance sheet. Okay. Second, we have to make the workings for creditors. Okay. Second, we have to make the workings for creditors. You all can see here, creditors are 2,50,000. Creditors are 2,50,000. So in the workings, creditors 2,50,000. Now how they are to be settled? Okay, how the creditors are to be settled? Sixth adjustment. The creditors of W Limited to get from S Limited 50% of their dues in cash. Let's do this first. 50% of their dues in cash. What is 50% of 2,50,000? Okay, what is 50% of 2,50,000? 1,25,000 that they are going to get in cash. Further, read the adjustment, same adjustment. What do you see here? Sixth adjustment. And 25% in the form of equity shares of 10 each fully paid up in full settlement. 25%. What is 25% of 2,50,000? 62,500. That they will get in the form of fully paid equity shares. But of what value? 10 each fully paid up. Okay. Here fully paid up, they don't have to pay any amount in future. So how this 62,500 is going to be paid? By issuing equity shares. And how many number of equity shares will be issued for that? 62,500 divided by 10. 10 each fully paid up. 6,250 equity shares will be issued to pay 62,500. And 125,000 plus 62,500. What is the agreed value? 50% plus 25%, 75% only. We are going to settle them only at 75%. So that comes to 1,87,500. Okay, 1,25,000 plus 62,500. That is 1,87,500 is its agreed value. Okay, even if you do 2,50,000, 75% only is settled. You'll get 1,87,500 is its agreed value. Okay, if any confusion, you can pause the video, rewind it and listen to it again. The question is very lengthy, so I'm explaining only everything one time. Now, third working we find for purchase consideration by net asset method. Okay, because the details of payment of equity shares are missing, we have to find purchase consideration by net asset method. First, agreed value of assets taken over. So you all will get here. First is land and building, but 40% more, so 5,25,000. Okay, from adjustment number 4 you all can see. Land and building 5,25,000, 40% more value. Land and building 5,25,000. Then after land and building, what do we have? Value of plant. Okay, you all can see in balance sheet plant and machinery 3,50,000, but that was to be reduced by 10%, so 3,15,000 is its agreed value. Okay, plant and machinery 3,15,000. Then after plant and machinery, which is the next asset in balance sheet? Stock. But stock's value is directly given over here as 1,65,000. Stock is to be reduced to 1,65,000. So stock directly we will write 1,65,000. Then after stock, debtors. Now debtors they have mentioned they are 175, but they are reduced by 5%, so 166,250. Okay, debtors 166,250. Then after debtors we have cash and bank always at book value. So cash and bank you all can see 40,000. We'll take it as it is. Cash and bank 40,000. So total agreed value of assets taken over is 5,25,000 plus 3,15,000 plus 1,65,000 plus 166,250 plus 40,000. That comes to 12,11,250. From that we will minus agreed value of liabilities taken over. Now agreed value of liabilities taken over, 3 liabilities are there. First is debentures, 3 lakhs itself we have seen in the working note 1. We just did the working to find the number of equity shares, but 3 lakhs itself is its agreed value. So 9% debentures, 3 lakhs. Then we have unsecured loan. You all can see unsecured loan of 2 lakhs and creditors then. So unsecured loan 2 lakhs. And then creditors, for creditors we have done this working note 2. Agreed value is 1,87,500. Okay, 3 liabilities were there. So 6,87,500 is the agreed value of liabilities taken over. 3 lakhs plus 2 lakh, 5 lakh plus 187,500, 687,500, which we will minus from 12,11,250. What we get is 5,23,750. Okay, 5,23,750 is the purchase consideration by net asset method. Now, how is this purchase consideration going to be discharged? There are two modes of payment. Okay, there are two modes of payment. First, preference shares. First mode of payment is preference shares. All of you look at adjustment number 2. To issue 3 12% preference shares of 10 each, but only 2.5 paid up in exchange of 1 preference share of W Limited. Now, second part we will take first. For 1 share, 3 shares are issued. Okay, second part we will take first. For 1 preference share in W Limited, 3 preference shares of S Limited are issued. So if you can see that 3 against 1. Okay, 3 against 1. Now, how many preference shares are there in the books of W Limited? 25,000. So for 25,000 preference shares, how many preference shares will be issued in S Limited? 25,000 into 3 divided by 1. 75,000 preference shares will be issued. Okay, in the new company, they are going to get which percentage of preference shares? They are going to get 12%. Okay, though in the old company they are 9%, in the new company they'll get 12%. So 75,000, 12% preference shares of rupees 10 each, but they are going to be issued at 2.5 paid up. Look at their adjustment again, all of you will find it. 2.5 paid up. Okay, means 7.5 will again collect from them in future. So rupees 2.5 paid up means we will multiply with 2.5 value. Okay, I repeat, 7.5 is not discount here, but paid up value is only 2.5, means 7.5 will collect from the shareholders in future. So 75,000 into 2.5, 1,87,500 is the value of preference shares we will give them. Now, second mode of payment is equity shares. What was mentioned for equity shares in the question? Necessary equity shares. First, we find the amount. Balancing figure. See, total purchase consideration is 5,23,750. From that, we will minus 1,87,500, what we are going to issue in the form of preference shares. So how much we will give in the form of equity shares? Remaining 3,36,250. Balancing figure. That we will give in the form of equity shares. I repeat, 523,750 minus 187,500 of preference shares. So what we will give in equity shares is 336,250. Now, if you read the adjustments of equity shares, third adjustment, S Limited to issue necessary number of equity shares of 10 each, 5 paid up to the equity shareholders of W Limited. So how many equity shares will be issued for this? 5 paid up means number of equity shares to be issued. Number of equity shares to be issued will be equal to 3,36,250 divided by 5, because it is 5 paid up. 3,36,250 is divided by 5. 67,250 equity shares will be issued. This will help us. Okay, you can say we are giving 67,250 equity shares of rupees 10 each, but rupees 5 paid up. This all will help us further when we pass the journal entries, balance sheet, etc. So this is the purchase consideration. Okay, basic three entries, workings are done. Now we'll proceed further with the formats. Okay, formats you all would have already made. So we proceed further with the journal entries in the books of transferor company W Limited and ledger accounts, realization, equity shareholders, preference shareholders. Plus we also have made S Limited, equity shares of S Limited and preference shares of S Limited. So journal and ledger we will make simultaneously. Let's proceed with that. So first entry in the books of transferor company. Okay, as we discussed in external reconstruction, the entries in the books of transferor companies will remain exactly same. So realization account debit, to assets account. Okay, closing of assets. So realization account debit to assets. That will include land and building 3,75,000, all assets at book value only. So land and building 3,75,000. Then to plant and machinery 3,50,000. To plant and machinery 3,50,000. Then after plant and machinery we have stock 1,75,000 to stock 1,75,000. Then after stock we have debtors. Debtors again 1,75,000. Then after debtors we have cash and bank 40,000. Okay, here we don't have to make cash and bank account because there is no other transaction of cash. We are not receiving any cash from transferee company. We are not selling any asset, not paying any liability. So cash and bank account is not to be made. Okay, all assets are done. We'll have to do the total. We cannot take from balance sheet because P&L was also there. 3,75,000 plus 3,50,000 plus 1,75,000 plus 1,75,000 plus 40,000. 11,15,000 being assets transferred to realization account. Now, entry for this realization account debit. So in realization account, we will write on debit side the opposite account to assets account. Land and building in inner column 3,75,000. Plant and machinery in inner column 3,50,000. Stock 1,75,000. Debtors 1,75,000. Cash and bank 40,000. Total, as we have done in the journal, 11,15,000. Now, second entry is to close liabilities. Only single effect of first entry, because the other effect is all the accounts get closed. Also, we are not making cash and bank account. Now, second entry is to close the liabilities. Liabilities account debit to realization. Three liabilities are there. So 9% debentures account debit 3 lakhs. Unsecured loan account debit 2 lakhs. Creditors account debit 2,50,000 to realization. Okay. 9% debentures account debit 3 lakhs. Unsecured loan account debit 2 lakhs. Creditors account debit 2,50,000. To realization account 8 lakh 50, 3 plus 2, 5 plus 2, 7 lakh 50,000. Being liabilities transferred to realization account. Okay, being liabilities transferred to realization account. Now posting to realization. So in realization account, we will write on credit side by liabilities account. In that 9% debentures 3 lakhs. Unsecured loan 2 lakh. And creditors 2,50,000. Total 7,50,000. First two entries are done. Single effect only for the closing entries. Okay, first 6 entries will have single effect because the other effect is the account gets closed. Third, equity share capital to equity shareholders. So here equity share capital 4,50,000 will be transferred to equity shareholders account. Equity share capital account debit 4,50,000 to equity shareholders account 4,50,000. Okay, equity share capital account debit to equity shareholders account 4,50,000 being equity share capital transferred to equity shareholders account. Now to equity shareholders, so equity shareholders account on credit side by equity share capital account 4,50,000. Now after equity share capital, here we also have preference share capital. So preference share capital account debit to preference shareholders 2,50,000. Mind well, in this question, the last point left out of preference shareholders realization difference amount is also going to get covered. It's a nice question. Preference share capital account debit 2,50,000 to preference shareholders account. Two lakh 50,000. Okay, and rather 9%, no, 6% preference share capital. Okay, to be more specific, 6% preference share capital to preference shareholders, being preference share capital transferred to preference shareholders account. Now two preference shareholders, so this will come in preference shareholders account on credit side by 6% preference share capital account 2,50,000. Okay, so first four entries are done. Now fifth is for reserves and surplus, but we don't have any. You all can see here, after preference shares, debentures, unsecured loan and creditors, there are no reserves and surplus. So six fictitious asset, we do have accumulated loss, other non-current asset or fictitious asset, negative reserve. So for this reverse entry, equity shareholders have to bear this loss. So equity shareholders account debit to profit and loss 3,35,000. Equity shareholders account debit to profit and loss account 3,35,000. Mind well, the same amount can also be given on liabilities side in reserves and surplus as a negative figure. But the entry would remain same, being on liability side doesn't become really a positive credit balance. If it's a negative figure, it's a debit balance only. To close it, we reverse and credit that and we transfer to equity shareholders account, being accumulated loss transferred to equity shareholders account. Now, equity shareholders account debit. So in equity shareholders account, we will write on debit side to profit and loss account 3,35,000. Okay, the first six closing entries are done with single effect. Now we begin the entries. 6 and 7 are for purchase consideration. First purchase consideration due. Amount is receivable from transferee company S Limited, debit the receivable S Limited account debit to realization account. What purchase consideration did we calculate in the workings? 5,23,750. Okay, 5,23,750. Being purchase consideration due. Now, seventh entry onwards, basically all the entries have two effects. So to realization account means realization account we will write on credit side by S Limited account in bracket purchase consideration, also working note 3. What amount do we get? 523,750. And opposite side in S Limited account to realization account 523750. Okay. Then after purchase consideration due, purchase consideration received. Now how is this 523750 received? 187,500 in the form of preference shares, 336,250 in the form of equity shares. So what entry we will pass? Preference shares comes in, debit what comes in, preference shares of S Limited account debit 187,500, equity shares comes in, debit what comes in, equity shares of S Limited account debit 323,750, sorry, 336,250, 336,250, and S Limited is the giver, credit the giver to S Limited account 5,23,750, being purchase consideration received. Now to S Limited, so S Limited on credit side we will write both the opposite accounts by preference shares of S Limited account 187,500 by equity shares of S Limited account 336,250. Opposite side in both the accounts, preference shares debit side to S Limited account 187,500. Equity shares on debit side to S Limited account 336,250. Okay, purchase consideration received. What other entries do we have after purchase consideration received? Sale of assets not taken over, we don't have, all assets are taken over. Payment of liquidation expenses, no adjustment mentions about liquidation expenses, we don't have. Payment of liabilities, we don't have, all liabilities are taken over. Now directly payment to preference shareholders. Now, what are we going to give to preference shareholders? Preference shares. And as you can see in the workings also, what we are going to give to preference shareholders is preference shares of 187,500. So here the difference will be transferred to realization account. Okay. Preference shareholders balance is 2,50,000, but we are paying them 187,500. So preference shareholders are the receiver. Debit the receiver. Preference shareholders account debit 2,50,000. Preference shares goes out. Credit what goes out to preference shares of S Limited account. We will give them preference shares of 187,500, and difference amount we will transfer to realization account. As we are paying them less, that profit will be earned by equity shareholders. How much less we are paying? 62,500. 2,50,000 minus 187,500, balancing figure being payment made to preference shareholders. So preference shareholders account, first we will do the payment on debit side to preference shares of S Limited account 187,500. Opposite side preference shares of S Limited account by preference shareholders account 187,500. Okay, opposite side we have done. Now preference shareholders, whatever balance remains, that you transfer to realization account. So 2,50,000 minus 1,87,500, 62,500 balancing figure we transfer to realization account, in bracket balancing figure. Opposite side in realization account by preference shareholders account, opposite side in realization account by preference shareholders account 62,500, in bracket it's a profit, we are paying them less. Okay, now after that we have the steps. Realization will be transferred to equity shareholders, then all other accounts will be transferred to equity shareholders, and equity shareholders must carry. So realization account credit side is more. First we do credit side total 7,50,000 plus 523,750 plus 62,500. That comes to 13,36,250. 13,36,250. Both the sides. Minus 11,15,000. So that comes to 2,21,250. That is the profit. It will be transferred to equity shareholders account, in bracket profit. Opposite side in equity shareholders account by realization account in bracket profit 2,21,250. Now what will be the journal entry for this? Since in realization account it's on debit side, realization account debit, and equity shareholders it's on credit side, so to equity shareholders account. Okay, ninth entry, realization account debit to equity shareholders account $2,21,250. Being profit on realization transferred to equity shareholders account. Being profit on realization transferred to equity shareholders account. Now, last entry, all other accounts will be closed and transferred to equity shareholders account. So first is this equity shares 336250. In fact, that is only one account. All other accounts have already got closed. Preference shares gets closed. Okay, S Limited already closed. So only equity shares balance is remaining. That we have to close and transfer to equity shareholders account. 336,250 by equity shareholders account in bracket balancing figure. Opposite side in equity shareholders account, 2 equity shares of S Limited account 336,250. And after this, equity shareholders must tally, all accounts must get closed. So 3,35,000 plus 336,250 comes to 671,250, and credit side 4,50,000 plus 221,250 also comes to 671,250. Okay, now posting for this last entry, equity shareholders, it's on debit side, so equity shareholders account debit. Equity shares of S Limited, it's on credit side, so 2 equity shares of S Limited account. Okay, 10th entry, equity shareholders account debit. $336,250 to equity shares of S Limited account $336,250 being payment made to equity shareholders. Okay, now formality journals total is to be done. So 11,15,000 plus 7,50,000 plus 4,50,000 plus 2,50,000 plus 3,35,000 plus 523,750 plus again 523,750 plus 2,50,000 plus 221,250 plus 336,250. That comes to 47,55,000. So accounting in the books of transferor company is completed. Now I suggest, it's a very long question, so all of you can pause the video, take a break of around 30 minutes, half an hour, relax yourself, have tea or coffee, have some breakfast, lunch, whatever you are doing right now. Okay, or go and watch some television, have some entertainment, and come back after 30 minutes, and then you do the accounting in the books of transferee company, that is journal entries and balance sheet. So pause the video, relax a bit, take a break, and then watch the video further. Now, journal entries in the books of S Limited, I hope everyone has made the format. Here, as it is amalgamation in the nature of merger or purchase, it's an external reconstruction, and we discussed. As it is an external reconstruction, we are going to do purchase method of accounting only. We are going to follow purchase method of accounting only in the books of transferee company. We don't have to verify is it amalgamation in the nature of merger or purchase blindly. In any question of external reconstruction, we have to follow purchase method of accounting. So first entry by purchase method of accounting, business comes in debit, what comes in business purchase account debit, with the purchase consideration of 523,750 and amount is payable to the liquidator, credit the payable, so to liquidator of W limited account, transferor company, that is W limited account 523750, being business of W limited purchased. Now second entry, taking over of assets and liabilities. Do we have to make the workings to find goodwill or capital reserve? No, because we have obtained purchase consideration by net asset method. This we have done earlier also. If purchase consideration itself is obtained by net asset method, then what are net assets? Agreed value of assets minus agreed value of liabilities. So net assets are itself equal to purchase consideration. Neither we are paying more nor we are paying less. So goodwill or capital reserve will not come. Directly from this third workings we'll get the second entry. Land and building account debit with 5,25,000. Then after land and building we have plant and machinery account debit with 3,15,000. Then after plant and machinery we have stock account debit with 1,65,000. Then after stock we have debtors account debit with 166,250. Then after debtors we have cash and bank account debit with 40,000. So assets account debit is done. To liabilities account we have to 9% debentures 3 lakhs. Then to unsecured loan 2 lakhs. Then to creditors account 187,500. And lastly to business purchase account with the purchase consideration of 523750. Now after this entry we always have to verify debit is equal to credit or not. So debit 5,25,000 plus 3,15,000 plus 1,65,000 plus 166,250 plus 40,000, that comes to 1,12,11,250. We'll verify with the credit one, 3 lakhs plus 2 lakhs plus 187,500 plus 523750, and you'll find it comes to 12,11,250, being assets and liabilities of W Limited taken over. Being assets and liabilities of W Limited taken over. Then third entry, settlement of purchase consideration. So first this liquidator of W we will debit with 523750. Liquidator is the receiver, debit the receiver. So liquidator of W limited account debit with 523750. Okay. Now what are we giving this for this 523750? 187,500 of preference shares. They are given at par only but 2.5 paid up. So we have to credit share capital with 187,500 itself. Same way 336250 we are giving in the form of equity shares. Again we are giving at par only but 5 paid up. That all 2.5 paid up and 5 paid up will come in balance sheet. But in journal entry we have to credit share capital with full amount, that is 187,500 and 336250 itself. So to 12% preference share capital account 187,500 to 12% preference share capital account 187,500 to equity share capital account 336250 to equity share capital account 336250. I hope everyone is clear with that. Okay. Now, being purchase consideration settled. Now, fourth entry is for public issue of shares that we have in adjustment number, last adjustment, that is adjustment number 7. To facilitate the implementation of reconstruction scheme, S Limited issued for cash 20,000 equity shares of 10 each, which were fully subscribed. So two entries will come for this. 20,000 into 10, 2 lakh will be the value. Bank account debit to equity share application and allotment account 20,000 into 10, 2 lakhs. Being application money received. Then we'll transfer it to share capital. So equity share application and allotment account debit to equity share capital account with full amount of 2 lakhs. Being application money transferred. Next, public issue is done. Now, liquidation expenses are not given in the question. No liquidation expenses of W Limited are mentioned to be paid by S Limited. Okay. Establishment, registration, and other expenses are also not there. Settlement of liabilities. Fifth and sixth both are settlement of liabilities. Debentures are settled by giving equity shares. Creditors are settled by giving cash as well as equity shares. First we take up with debentures. Okay, so these debentures, 9% debentures, 3 lakh we have to reverse and debit to settle the liability. 9% debentures account debit with 3 lakhs. Now what are we giving against that? Equity shares. So to equity share capital account 3 lakhs. Okay, what we have given to them is, as you can see even in working note 1, 60,000 equity shares of 10 each but 5 paid up. So 60,000 equity shares are given to equity share capital 3 lakhs, being equity shares given to debenture holders. Then 7th, again settlement of one more liability is there, creditors account debit. Again creditors, all of you see in the second entry, like debentures, creditors account we will debit with what amount? 187,500. Okay, creditors account debit 187,500. Now what are we giving to them for this 187,500? Working note 2, cash of 1,25,000 and equity shares of 62,500. So to cash and bank 1,25,000 and to equity share capital account 62,500. To cash and bank account 1,25,000 to equity share capital account 62,500. Being creditors settled. Okay, all entries are done. If at all we have one extra entry, that is of statutory reserves, but we don't have that here. In the question you all can see there are no statutory reserves. So total of journal is to be done for the formality. Now see this everyone. 523,750 plus 525,000 plus 3,15,000 plus 1,65,000 plus 166,250 plus 40,000 plus 523,750 plus 2 lakhs plus 2 lakhs plus 3 lakh plus 187,500, 31 lakh 46,250. Okay, the total comes to 31 lakh 46,250. Now, if you have already taken the break, don't take further any more break. Make the format of balance sheet. Okay, all of you. Balance sheet of S Limited on 1/4/19, make a blank format. First we will make the notes, then we will do fill in the blanks in the format of balance sheet. You can pause the video and make the format, and you already know which items come in balance sheet. Equity and liabilities, shareholders funds, share capital, reserves and surplus, non-current liabilities, current liabilities, asset side, non-current assets and current assets. So make the blank format, okay, with the respective items of balance sheet, then pause the video. So I hope everyone has done the format. Now first note will be of share capital. Okay, first note we will make of share capital. First, authorized capital. Now, authorized capital is given in adjustment 1. So that we are supposed to write 3 lakh equity shares of rupees 10 each and 12% 1 lakh preference shares of 10 each. 3 lakhs and 1 lakh. Okay. So in authorized capital we'll mention that 3 lakh equity shares of rupees 10 each, that is 30 lakhs, and 1 lakh 12% preference shares of rupees 10 each, that is 10 lakhs. Double underline not to be included in the total. Then we have issued, subscribed and paid up capital. Now issued, subscribed and paid up capital, be attentive everyone. You have to be very careful with this. 60,000 equity shares but they are 5 paid up. Okay, 60,000 equity shares but they are 5 paid up. Then 67,250 equity shares, again 5 paid up. So we can combine it. 60,000 equity shares of 5 paid up which are issued to debenture holders plus 67,250 equity shares of 10 each, 5 paid up. We can combine because both are 5 paid up. However, these equity shares, okay, these ones are fully paid up 10 rupees. You all can see here which all are 5 paid up. Equity shares issued to equity shareholders are 5 paid up. Debenture holders are 5 paid up, but creditors are fully paid up. So we cannot combine creditors with that. What we will do is 5 paid up value shares first we will write. So 60,000 equity shares and this 67,250, 1,27,250 shares are 5 paid up. Write down 1,27,250 equity shares of rupees 10 each, but comma rupees 5 paid up, and we will multiply with also 5. So 127,250 multiplied with 5, 636,250. Now further, these equity shares are fully paid up which are issued to public, 20,000 equity shares of 10 each, and also to creditors are fully paid up, 6250 shares of 10 each. So these we can combine as they are fully paid up. 20,000 plus this 6250 which are issued to creditors are fully paid up. You can also see in adjustments it is mentioned what we have given to creditors are fully paid up. So these two we can combine. Which two? Which are fully paid up, 10 rupees paid up. They are 6250 issued to creditors and 20,000 issued to public. So 26,250. Okay, 26,250 equity shares of rupees 10 each, fully paid up. That is 2,62,500. Okay, this 127,250 are 60,000 plus 67,250. 60,000 issued to debenture holders, 67,250 issued to equity shareholders. 26,250 are 20,000 issued to public plus 6250 issued to debenture holders. Now preference shares turn 75,000 preference shares of 10 each, 2.5 paid up. Okay, 75,000, 12% preference shares of rupees 10 each, comma, rupees 2.5 paid up. So that will come to 187,500. Okay, 75,000 into 2.5. So total share capital comes to how much? 636250 plus 262500 plus 187500, that comes to 1086250. Total share capital 10,86,250. Okay. Now here disclosure of above. Now of above which all are issued for consideration other than cash? 60,000 issued to debenture holders are for consideration other than cash. Even 67250 issued to equity shareholders are consideration other than cash. 20,000 is issued to public for cash. 6250 given to creditors are for consideration other than cash. So 60,000 plus 67250 plus 6250, total 1,33,500 equity shares, and all preference shares are for consideration other than cash, they are given to preference shareholders only, and 75,000 preference shares are issued for consideration other than cash. Okay, they are issued for consideration other than cash. I repeat, only 20,000 shares which are issued in public are issued for cash. Rest, these are issued to debenture holders, these are issued to equity shareholders, these are issued to creditors. So 60,000 plus 67,250 plus 6250, 133,500 equity shares and 75,000 preference shares are issued for consideration other than cash. Reserves and surplus, we do not have. Do we have any reserves and surplus in second entry? No. Do we have any reserves and surplus statutory reserves? Do we have any security premium? No. So reserves and surplus we don't have. After reserves and surplus, long-term borrowings. So directly here we will have long-term borrowings. Now in long-term borrowings, this 9% debentures account gets closed because we have given them equity shares. So now equity shares means that long-term borrowing also will not come because debentures are not issued. We have issued equity shares and already counted in equity share capital also. Okay. Which other long-term borrowing do we have? Unsecured loan of 2 lakhs. So unsecured loan of 2 lakhs will come in long-term borrowings. Then after long-term borrowings, what next thing will come in the balance sheet? Other non-current liabilities, long-term provisions, short-term borrowings, we don't have. Trade payables. But trade payables also will not come, they are closed. You all can see here in the entry. Creditors account we credit with 187,500 and we debit with 187,500. Full settlement was already done. So even creditors, that is trade payables, won't come. Other current liabilities, short-term provisions, we don't have. Directly non-current assets, fixed assets. So third note is straight away for fixed assets. What will we have in fixed assets? Look at the second entry. Land and building, 5,25,000. Plant and machinery, 3,15,000. Two things. Land and building, 5,25,000. Plant and machinery 3,15,000. So total non-current fixed assets what we have is 8,40,000. Then intangible fixed assets, we don't have any goodwill in this question. Okay. Then non-current investments are also not there. Then long-term loans and advances and other non-current assets are also not there. Current investments are not there. Inventories, we have stock. So directly inventories, that is stock of 1,65,000. Inventories, stock 1,65,000. Total also 1,65,000. Then trade receivables, that is debtors. Now debtors are how much? 166,250. Total also 166,250. Then after debtors, cash and cash equivalents. Now what do we have to write in cash and cash equivalents? Cash and bank, and all the debit amounts will be added, credit amounts will be subtracted. Let's look for those amounts. So cash and bank 40,000 we will add. Okay, debit amounts we will add, plus 2 lakhs. We will add 40,000 plus 2 lakhs, that is 2,40,000. That's it. And credit amounts we have to minus. So from that we have to minus this 1,25,000 paid to creditors. So 1,15,000. Okay. Cash and bank 1,15,000. How do we get this? 40,000 from second entry plus 2 lakhs from fourth entry minus. How much is paid? 1,25,000 is paid to creditors. That we will minus. So 2,40,000 minus 1,25,000, 1,15,000. Then we don't have other items. We don't have short-term loans and advances and other current assets. Now let's do fill in the blanks. All of you should have already done the formats. Share capital, note 1, we get 1,086,250. Okay, this 1,086,250 total amount of share capital. 1,086,250. Reserves and surplus is not there. Total also 1,086,250 shareholders funds. Long-term borrowings from note 2 we get 2 lakhs. We don't have other long-term liabilities and long-term provisions. So total non-current liabilities 2 lakhs. Then we don't have any current liabilities. Directly after that we have fixed assets. Okay. So short-term borrowings, trade payables, other current liabilities, short-term provisions are not there. Total 12,86,250. Then non-current assets, fixed assets from note 3 we get, that is 8,40,000. Okay, fixed assets 8,40,000. Tangible. Okay, these are tangible itself. Okay, they are tangible fixed assets. Intangible fixed assets we don't have. Non-current investments loans and advances, non-current assets, other non-current assets we don't have. Total 8,40,000. Current investments we don't have. Inventories we have in note number 4, that is 1,65,000. Trade receivables we have in note 5, that is 166,250. Cash and cash equivalents we have in note 6, 1,15,000. Short-term loans and advances and other current assets we don't have. So 1,65,000 plus 166,250 plus 1,15,000. Total current assets are 446,250. In that, if we add 8,40,000, then 1,286,250, the balance sheet gets tallied. So I hope everyone is clear with this question of external reconstruction. Any point of doubt, everything is very well explained. You can pause and rewind the video and listen to that once again. One more question to go in this chapter of external reconstruction and the chapter gets over. So in this week, the chapter shall get over. Bye everyone. Take care. See you in the next lecture.